We're going to take a little bit of time and discuss the great controversy, the great debate of active versus passive management. We discussed index funds briefly when we talked about the fees that mutual funds charge investors. And we found that because index funds are passively managed, which means they simply hold the number of stocks or bonds that are in some specific list, usually called an index or sometimes called an average. There's no active management performed, and because of this, they should be charging you very, very little. Remember, there are some index funds that charge a whole lot more than what should be charging, and they're typically hidden inside a 401k or a 403b or other employer-sponsored plan. So be careful. Remember, you are the line of defense for your fellow employees and yourself. So they choose an index, and we'll discuss these indexes more in detail in the next chapter: S&P 500, Dow Jones Industrial Average, Russell 2000, and like. Why do they do this? Well, because they can offer much lower annual fees. As we said, they're not doing any research. You or I could run the fund, assuming we can read the list of stocks or bonds that are on the index. And it turns out that many actively managed funds don't beat their respective index. Well, yes, and we'll discuss this in a bit. Because of the annual fee, though, the index fund cannot actually match the market's performance, but it should come very close. As we saw with the Vanguard fund in the second presentation on fees, we saw that it didn't actually match the Standard & Poor's 500, but it came very, very close, providing the annual fee is not excessive, whereas we saw two actively managed funds that substantially outperformed and one that substantially underperformed the market index. Well, the rationale for index funds came from research done in the late 1960s, early 1970s, that statistically showed that many of the actively managed funds did not beat the market. They said, you could have done better if you were a monkey just throwing darts at a dartboard. And this is true. This is true. The average mutual fund does not beat its respective index. Well, think about it, folks. They have to at least beat the index by the fees that they charge just to break even. And it's true, some mutual funds don't beat the index, but they're not designed to beat the index. It's not fair to ask an equity income mutual fund that invests in boring stocks like railroads and utilities to beat the S&P 500, which has both growth and value, boring companies and exciting companies. And the truth is, folks, that many actively managed funds do beat their respective indices over statistically significant periods of time. I mean, 1 or 2 or even 5 or even 10 years is not a good measure, especially the last 10 years where growth has clobbered value. You have to look 20, 30, 50, 70 years, and that's what we're going to do. In our next presentation, we're going to look at some mutual funds that have beaten their indices over decades. So you want to look for a fund family, and we'll discuss fund families in our final presentation, next presentation, where most all funds have consistently beaten their respective indices over a decade. And you have to compare apples to apples. You have to make sure that, yes, they're comparing this mutual fund to this index, but you know what? It's not a really good comparison. And it turns out that index funds are not perfect. They have their own issues, and they've become victims of their own success at times. Here are some of the indices that we will discuss in detail in the next chapter, so don't try to memorize these, folks. But as you are going through your assignment in chapter 2, you're going to want to find out which index the mutual fund is compared against. And typically, Morningstar and Yahoo and other websites will tell you, they'll give you what they think is the comparative index, and then go to the mutual fund's website itself, download their annual report, the prospectus, and they will tell you what they think, what indices they should be compared against. What you will find is that index funds are now the current perfect investment. Oh, don't go with an active managed fund. You need an index fund, and make sure it's a low cost index fund. And whoever tells you that is actually got their head screwed on straight, because some index funds are not low cost. And there are places that websites like and I'm not picking on one, IFA.com, because they're an index fund advisors, and of course they want you to sign up with them so that they can tell you which index funds are the best. What are the downsides to index funds? Well, we'll see in a moment that they're not perfect, right? Nothing's perfect. Nothing we humans have ever done is perfect. The growth and success of index funds has spawned exchange-traded funds. Now, there's some confusion going on here, so stick with us now. We've already discussed exchange-traded funds. What are they? They're a hybrid of both open-ended mutual funds, but they trade on the exchanges like closed-end mutual funds. So there's, like an open-end fund, there's no limit to the number of shares. The more investors send more money, they can create more shares, but you don't buy them and deal with the mutual fund company, you deal with your brokerage firm. And they have become very popular. Why? Because, like index funds, they can charge very low fees, because they don't even have to worry about the accounting. That's done by the brokerage firms, right? And they can be bought and sold throughout the day like stocks. So many people, many traders, speculators are now using ETFs as trading vehicles. And one of the big proponents of index funds, Jack Bogle, we've already made mention of him. He was not too happy about the way ETFs were being used by many people. But again, that's the traders, that's the speculators. We're not going to be that. We're going to be prudent long-term investors. So you can use an ETF like a prudent long-term investment. However, here's the problem. ETFs are not always index funds. Although they started out as being index funds, passively managed, no active management, there are now actively managed ETFs. I'm sorry, ETFs. Yeah, ETFs. ETF is electronic fund exchange or something like that. So now you have to be careful. Some mutual fund companies have ETFs, but they're not index funds. And you'll notice that the fees are higher because if you're doing it right, if you are running a mutual fund well, it's not cheap. It's very expensive to go do the research that's needed, because companies are global all around the world. And so we'll probably see the same thing. Some of these, well, obviously we will. Some of these actively managed ETFs will prove their mettle and beat their respective indexes over statistically significant periods of time. And others will, not do so well. But the best thing about ETFs is they have cool names like Spider and Diamond and Cube. I mean, how can you beat that? Spiders. I want to invest in spiders. Now, we're going to show you a slide. And again, this is one of the problems of teaching, putting mutual funds before stocks, because you don't know what PE is. Maybe you've heard it. Maybe you got some vague idea. But we said, what are the downsides of index funds? Well, it turns out that sometimes an index, a list of stocks, can become skewed toward a particular sector of the economy or region of the world. And we're going to discuss this in detail later on. But here is a graph that shows you two indices. Now, again, you don't have to, next chapter, you're going to have to memorize these guys, but don't worry about them now. This is the Morgan Stanley Capital International Europe, Australia, and the Far East Index. You knew that, didn't you? People just call it the EFA, and it's kind of, it's kind of obsolete now. They have another one that's even worse. It's hard to remember. But this is meant to show the foreign investments, the international stocks outside the United States. And then the Standard & Poor's 500 is the one that we use when we discuss this United States market. Specifically, it's the 500 largest companies, give or take a few, in the United States. What happened in the 1980s? Well, some of you, it's ancient history, but I remember it, and Japan was going to take over the world, right? They were selling cars that were far superior to United States cars, and the United States manufacturers said, we got to up our game, and they have. And the Japanese stock market went in two directions, up and way, way, way up. Just incredible amounts of gains were being done in Japan. And everyone thought Japan was going to take over the world. You hear the same thing now, but it's about China, right? And so at the end of the 1980s, the Japanese stock market made up almost 60% of the EFA. Now, the EFA is Europe, Australia, and the Far East. So also Canada, and I think South Africa, Hong Kong, Singapore, Australia, of course. And so that was the major foreign international markets at the time. Western Europe, of course. I'm sorry, forgot about Western Europe. But look, Japan made up 60% of it. Everybody else was 40%. That means Canada, Western Europe, South Africa, and the like, Australia, Singapore, Hong Kong. Now, what's this? PE. Well, we're going to discuss PE in detail in the next chapter, but price to earnings ratio is a measure of how optimistic investors are about the prospects of the investment that they're investing in. A PE of 51.9 is very high. And so investors just thought that Japan's stock market was going to continue to go up, 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 and up. So they were willing to pay a very high price for their investments. Whereas everybody else, Western Europe, Australia, Hong Kong, Singapore, had a PE of 13, which is very reasonable. We're going to find out in the next chapter. Well, what happened? At the end of the 1980s, Japan's stock market, I think, was like 37,000. It then fell down to 8,000 and has never, ever recovered since then. Japan has been in a deflationary, it's called, cycle for decades. And there are some very good companies in Japan, don't get me wrong, but the market as a whole has never recovered from its bubble. So you thought you were broadly diversified with foreign, international, overseas investments. In reality, you had 60% in the Japanese stock market. Again, we're going to come back to this idea. You were not broadly diversified. You were skewed or tilted toward a very, very expensive category. And the same thing happened in the 1990s. In the 1990s, the stock market in the United States went in two directions, up and way up. And by the end of the 1990s, specifically the peak was in March of 2000, the Standard & Poor's 500 companies, fully 33% of the market value was information technology. Companies like Apple and Microsoft and Intel, but also AOL, American Online, and other internet-related companies that are gone, basically disappeared. So the PE was 59.2, even higher than Japan 10 years earlier. And everybody else in the United States, we're talking energy and healthcare and basic materials and consumer products and housing and automotive, all the other categories in the United States made up 2/3 of the S&P 500, and with a PE of 19. A little high historically, but not outrageously high. So you thought you were getting a broadly diversified index of stocks, when actuality, in the reality, was 1/3 of it was in a very pricey category. Well, what happened? Over the next 2.5 years, from March of 2000 to October of 2002, the Standard & Poor's 500 lost about 50%. But the technology sector lost 80%. Right, exactly. So you were not as diversified as you thought you were. And internet-related index lost over 90%. So you see, just because you have a broadly based index, you think, doesn't necessarily mean that your investments are broadly based. And there is a bonus assignment that I really want you to do because it's easy. It'll take you all 5 minutes. We want you to look up the top 10 companies in the Standard & Poor's 500, and for whatever time frame you can find, end of month, end of quarter, end of year, whatever. And you'll find a very, in my humble opinion, disturbing statistic. The top 10 companies make up a significant portion of the Standard & Poor's 500. The top 50 companies. So should we really call it the Standard & Poor's 500? How about the Standard & Poor's 50 or Standard & Poor's 10? And that's what we have now. And you will hear people jump up and down and say, oh, you should only own the S&P 500. But as far as the manager is concerned, when you have an index fund, the manager is completely constrained. They really can't make any judgment. They can't say, you know what, this is a great company, but it's wildly overpriced, and I'm not going to invest it. Or if I have it, I'm going to sell some shares. Maybe I'll keep a little bit of shares. And so the same thing happens on the downside. If a company has been hit on hard times, the manager can't say, you know what, this is a great company, but look what happened to the stock. It got clobbered. I'm going to buy more shares, or I'm going to take an initial position. You have removed judgment from the equation. And some people, many people will say that's a good idea because humans are really bad at judgment. And I would submit to you that it depends on the human. Some people, are really bad at judgment, but others not so much. In fact, others are very good at it. So you get this feedback mechanism. If the company keeps getting more and more expensive, the manager has to buy more shares. They can't say, no, this is too expensive. And so that props up the price, which makes people buy more. And so you get a feedback spiral upward, and the same thing happens when the prices fall. Many years ago, a gentleman by the name of Benjamin Graham, we've mentioned him before, we'll mention him again, warned against any strategy that removed judgment from the equation. He said, judgment is important. And in my humble opinion, index funds remove that. Remember, you're going to hear it differently from somebody else. And but the most important thing is that you question the conventional wisdom. Whether it's me saying it or anybody else saying it, you have to make your own decisions. Now I'm going to jump to the book, which I'm hoping you're reading because remember, it's free. And this is a quote from a former mutual fund manager. He since is retired, but he says it very well. And he was actually a very, very successful manager. As with any human endeavor, whether it is athletic competition, the performing arts, or technological innovation, some people clearly perform at a higher than average level. Yeah, sure, the average person, the average mutual fund, and the average person can't beat the index, but there are people who have. The average person can't hit a fastball at 98 miles an hour, but there are people who can. And if you can do it 3 times out of 10, you're going to make several $1 million a year. And then we end with a quote by the gentleman who actually started, one of the gentlemen who started the Morning Star. The active versus passive debate has been greatly overplayed to the detriment of many fine, actively managed fund shops and to intelligent investment discourse. And so Mr. Phillips is making a statement, and he's also making a warning. When you question people's belief that index funds are the only way to invest, they get angry. They get really angry. And they say, oh, you're just shilling for whoever you say has done really well over the next several decades, the last several decades. So just be careful. Sometimes it's best if somebody's already convinced that the only way to invest is index funds. Sometimes it's better to just nod your head and say, well, make sure it's a broadly based index. And if they say, well, the S&P 500, you say, well, maybe you want to do the Chapter 2 bonus assignment in BUS123, because is the Standard & Poor's 500 at this time really that broadly based? Okay. That's my 2 cents for what it's worth. We're now ready to wrap up. In our final presentation, we'll finally ask the question, okay, how do I pick a mutual fund? And the answer is, it ain't easy. But once you've chosen it, it's downhill slide from there, because it's all their job now. All you have to do is make sure the $50 comes out of your checking account or paycheck, or the $100 every month, and let the market do its thing and let the mutual fund do its thing. So we'll see you in our next presentation, where we take a look at fund families, some last odds and ends about mutual funds, and then how do we choose a mutual fund. And we're going to find out that if we choose well, the news is good, providing the world doesn't end. See you in our final presentation for mutual funds, dear students. Thank you so much for being in our class.